Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is a silver expert. He's written the Morgan Report newsletter for decades. He's also the author of multiple books on silver, including his grand manifesto, the Silver Manifesto, that he co-authored with Chris Marchese. David Morgan, thank you for joining me again.
Jason, it's been too long, and thank you for having me back.
So, David, we're recording this interview on Monday, March 13th, 2023. We have the Silicon Valley Bank and Signature Bank. I want to get your thoughts on this relative to what you put out in the book, the Silver Manifesto. You spent a lot of time talking about Austrian School of Economics in the book. It's available on Audible audiobook if my listeners want to go buy it. And you talk about the Austrian School boom and bust cycle. Do you think what's happening now with these small, medium-sized banks, is this a textbook case of the Austrian boom and bust cycle where we had the boom and now what the Fed rate hikes are kind of the pin in the bubble that are causing the bust?
Well, I'm too conservative to say absolutely yes, but I certainly would say a cautioned yes. We're in a situation, as you well know, Jason, that as I outlined in the book, you can only push this thing so far. And I'm on record. And most of my peer group were not in the same page. My take was that the Fed will continue to increase rates until something breaks. I think I'm vindicated on that statement. A lot of my peer group were they're going to pivot a week from tomorrow and blah, 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 blah. It's going to be interesting to see what they do from this point forward. I would call, and this would be for your more sophisticated listeners, but if you do a little history and you look at what happened in the Great Depression, there was a little bank called the Kreditanstalt Bank in Austria, and it wasn't that big a deal, and it failed. But that started the dominoes of the chain reaction because all the banks then, as now, were interconnected. And I'm really looking at Silvergate as the start, not SVB, Silicon Valley Bank. And of course, history will, provide the look from, 5 years out, 10 years out, whatever it becomes. The point I'm making is that there's been a lot of misallocation of capital that Chris and I continually pound on. And at some point, something blows up. And I think, unfortunately, or maybe unfortunately, it's inevitable. Let me restate that. Since it's inevitable, people like me, you, and others have looked wrong for a very long time. I mean, I got one of my books on my bookshelf back here is Bankruptcy 1999. And that was a hard case for the U.S. Really, its balance sheet was bankrupt back then, and that was 24 years ago. The point is, it's here now. What are we going to do about it? So, yeah, I feel vindicated, but I'm not gleeful about it. I know what's coming, and if I'm correct about it being a greater depression instead of the Great Depression, that's very, very it's tough to handle because I don't want to see anyone suffer. But yet, these markets are so distorted to get back to quote unquote normal. It's going to take a lot of productivity out of the market, unfortunately. Real economic, physical economy is going to deteriorate.
And so with Silicon Valley Bank, it looks like the stockholders and the bondholders are going to get wiped. However, and we're being lied to again, there's spin, lies, bailouts. They're going to paper over a lot of this stuff. I heard stories that one of the subsidiaries for Silicon Valley Bank, that HSBC Bank, was able to buy it for unbelievable discounts, the part out of London. And then you just hear stories. You hear people like Janet Yellen. She was on Sunday morning news saying there would be no bailouts. And then a couple hours later, the story changes. Or they're saying that there's going to be no losses to the taxpayer. And now you have the FDIC, and the FDIC, David, is basically insolvent. I mean, they have to go hat in hand to Congress, and Congress has to then ask the Fed to print more. So the FDIC can't really handle multiple small, medium, large banks all failing at the same time. They just don't have the funds, not without the Fed printing it. And now it looks like all the rich depositors that had way over 250,000 in cash, they're going to get bailed out, and the smaller guys are frozen for a while, or they're going to get screwed, or maybe they're going to get their funds back. But it just seems like a headache here with rules and distortions. A lot of the lessons that should have been learned, though, in 2008 with Lehman Brothers, it seems that people in power, David, didn't learn any of the lessons they should have.
Yeah, you put out a lot to break down. I'll start with the last statement. They didn't learn anything. In fact, they made it worse. And that's unfortunate because 2008 got us a lot closer to a complete collapse than most people realize. But here we are for, I guess we'll call it round two. And the rules change, as you said. It reminds me of Animal Farm. All animals are created equal, except some animals are more equal than others, which is very unfortunate because the way that the republic really functions best is the same rules, laws, and accountability for everybody, regardless of how big your bank balance is. Yeah, it looks like the shareholders in SVB will get zero or next to it. Bondholders are a little bit different story because as a finance major like you, I mean, the bondholders get whatever the liquidation value is, or at least they're supposed to, which means whatever buildings or real estate or computers or chairs or tables they own, that gets divided up. And I don't like, the wishy-washy part of, who's going to be made whole and is it going to cost the taxpayer and all that stuff. I mean, all this stuff should be very clear-cut and applied correctly across the board, but it isn't, as you well know. So one thing that concerns me, and I wanted to get this in, so I'll say it now, is mathematically, I mean, any bank is insolvent in a way because it's a fractional reserve system. So if you had enough depositors that came in and said, hey, I need my money now, and the bank wasn't resistive and said, okay, then they would have to sell assets. Well, a lot of the assets of most of these banks are long duration bonds, so they have to discount them to the current interest rate, which means they got to take a haircut of whatever it is, 20, 30%, whatever the math is. And that's unfortunate, but that's reality. And of course, that's what was happening at SVB. And of course, now the powers that be have come in and said, oh, wait a minute, the rules have changed. In fact, I just did an update on this for my subscribers. And it said, if I read it correctly, that the Fed says, wait a minute, don't worry about that. We'll just fund you the cash. And what they were implying was that if you got a long duration bond, we'll give you whatever cash you need, using that as collateral. Don't sell it. You don't have to take the loss, which is, of course, favoritism. It's not the way a free market works. So I think I'm done.
But with Lehman Brothers, I mean, they should have let Lehman Brothers go bankrupt. And instead, because too big to fail in these banks and the derivatives, instead the people in power, if you ask them about Lehman Brothers, the people in DC or at the Fed, they say that they should have bailed out Lehman Brothers and that they shouldn't have let Lehman Brothers fail. So they learned the wrong lessons. And now here we are, almost 15 years later, and they're saying basically like, okay, it's just spin to the public right now because they are doing bailouts. They're saying it's not bailouts, but there are a lot of people getting bailed out. If you had over the FDIC limit of 250,000, I mean, you're going to be made whole with your cash.
Yeah, exactly the opposite of what is supposed to take place. So, and you brought to mind my actual major point, and that is on a bank run. A bank run is not mathematically based. As I just said 2 minutes ago, most banks are insolvent based on what their asset level versus what their liabilities are. However, even if the Fed comes in and does what you just outlined, Jason, it's a psychological phenomenon. It's a mindset. And here's the mindset, and I'll be so bold as to broad brush it. It's not everybody, but there's enough out there, enough people, institutions, fund managers, stockbrokers, other bankers that say something to the effect, we've been lied to for so long about this whole system that I don't care if they're going to make us whole or not. I'm going down to the bank and I'm getting my money out. That's a bank run. So it's an event that takes place in the mind. It's a cognitive map. It's the way you think. And if the way you think is, I don't care what they say, I'd rather be safe than sorry. And you go down and try to, withdraw your money, and too many do it, regardless of all this, grandma yelling, saying, the capital markets are strong and that we've got it all under control and don't worry about it, blah, blah. Whenever the Fed says don't panic, you should panic. So I think this could be, I won't say would be because I don't know yet, but this could be the beginning of what me and so many of my betters have said over the years, that we are in a financial, I won't say conundrum, collapse / rearrangement / predicament. I don't know the right adjective. It's scary, and I don't want to overdo it. I don't want to lay the fear card, but people that listen to Jason David Morgan over the years probably put some metal away and are probably feeling fairly comfortable right now.
And I think those rate hikes that started over 12 months ago, I don't think they were priced in. I think they're just starting to get priced in now with the risk and the volatility, because you're starting to see with these large companies, the subprime auto loan bubble. I don't think commercial real estate has had the bust yet that's coming. These large cap companies, they borrowed artificially cheap debt for 15 years because of zero interest rate policy. So they loaded their balance sheets with debt. Well, now with the Fed raising interest rates, their interest payments to service that debt are going to be astronomical. I mean, the US government can afford interest payments easier than a lot of corporations now. And then the other one is all these, and we've seen this with some of the banks, these banks and pension funds and hedge funds that were buying bonds with leverage, they all should have enormous losses on their bond portfolios as the Fed was raising interest rates. They haven't written off those losses. So I think now with the banks and their bond portfolios, we saw this with Silicon Valley Bank, they started to have a lot of losses because of the interest rate risk and the duration risk. So they started marking down the losses and having problems and then with their venture capital investments. So they had a lot of risky tech investments with Silicon Valley and others. And the losses are just starting to come, and a lot of it's because of the interest rate increases.
You're right. I just want to tweak it a little bit, and it's maybe nitpicking. I don't mean it to be so. I did read up on a few things over the weekend, and one is, in theory, let me emphasize that word, you don't have a mark-to-market problem unless there's a liquidity squeeze, which there is. So what that means is a lot of these banks aren't going to say we have a loss on the books because they don't. They're long duration bond yielding 2%. That's worth a lot less if they have to sell it. Well, guess what, folks? They have to sell it because it's one of the most liquid assets that they have, and they've got to cover those cash withdrawals. And the only way they do it is to turn that long-term bond into cash. And the way you do that is you take the loss. So everything you said is correct. I'm just pointing out the way the game is played, and the banks obfuscate the truth by not taking it on their balance sheet, showing you exactly what the truth is. They just carry it at par because they don't have to mark it down unless they have to sell it.
Thank you for pointing that out. So our listeners who are curious about that, I think there's going to be a lot more pain coming unless the Fed panics, does a 180 and starts cutting interest rates. But even then, I think the damage is already in effect because of how the interest rates were higher. So a lot of these companies still have really high debt servicing costs. I think that's coming with the consumer spending and others. It's not priced in, because I've been asking my guests, David, for the last 4, 5, 6 months, if the interest rate increases were priced in. And for months, I didn't think they were. I think now we're finally starting to see the problems with higher interest rates on all this debt and bad bond trades and stuff.
Excellent thinking. And I concur. I think you're right. I don't think the market was ho-hum. I mean, when things go very well for you for a long time, it's my belief that human nature just thinks you could keep going. They don't see the roadblock ahead. And so as interest rates continue to increase, it wasn't really priced into the market. Now it is. And usually for every action, there's a reaction. If there's an overreaction on one side, there's usually an overreaction on the other side. What do I mean by that? Zero interest rate policy? Are you kidding me? If you get zero rate of return, that means the money's worthless. I mean, if you really think it in theory. And this is very upsetting to me. I'm not gleeful that I'm right. I think I am.
The Fed had to make the banks look the Fed, excuse me, sorry to interrupt you, but take the zero interest rate policy and what the Fed also did with fractional reserve banking. I mean, in 2008, the Fed lowered reserve requirement ratios down to zero. Yes. So the banks, to make the banks look solvent, and they suspended accounting laws. So they did all these tricks.
Yeah. You're one of the few that knows that. In fact, I just got a question from one of my members on that exact situation. He says, what's the current reserve requirements? I said, I'm not sure. Let me find out. And in my little, I hate to use the word research, it's overdone, but in my Google search, I found what you just said. I don't remember it going to zero and having zero requirement for reserve. Are you kidding me? You know, if you really wanted to straighten out the banking system, it's too late. But, you know, if you go back a few decades, you don't have to mess with interest rates that much. All you have to do is increase the reserve requirement. And you say, you know, you got to have $1 in reserve for every 10 that are loaned out, which it used to be at that, but it isn't anymore. As you said, it's basically infinity money, free for all. We're not accountable. That's the other part, is the moral hazard. If you reward someone for failure, which has been done in 2008, and looks like it's going to be done again, the market can only take so much of that. That's not the way nature works. You don't get rewarded for doing something wrong or upsetting a balance. And the balance has been upset for a very long time. I'm afraid, then I'll use the word, the fear word, that not only is this going to be longer in duration than most people think, I think it's going to be deeper than most people think. And I think it's going to be wider spread than most people think.
I think there could be a lot of stagflation due to supply side problems in the commodities going forward. I mean, a lot of people think with high interest rates, with bankruptcies, guaranteed deflation, but the Fed has caused, like you said, so many distortions. There's a lack of investment on commodities and the supply side. Wages are going up. I mean, these could all be higher costs and stagflationary too, with the Fed distortions over the years.
Exactly.
So I want to transition now to gold and silver. And also the metals markets. I know the banks get away with a lot. The CFTC, the LBMA cover a lot of the stuff up. We had the commitment of traders delayed by over a month. Even the data that's coming out, David, recently, it's over a month old. So they're not releasing all this data that should have been out. They're not releasing it, catching everyone up quickly. They're releasing it. It's like a government bureaucrat saying, okay, we got the work done. There was a giant pile on someone's desk, tons and tons of extra work that's backdated, that's months old, and they just finally released something that's 4 or 5 weeks old and said, oh, hey, we started releasing this stuff. Do you think that the excuse about the hack, do you think that is accurate, or do you think that there's other shenanigans, like a bullion bank got caught with their pants down and the excuse is just the hack?
That's my take. I mean, and I don't know. So let me be clear. But yeah, I think there's something nefarious going on. There's been a lot that's taking place throughout the commodity sector. But if you look on a percentage basis and months held in paper assets, in other words, there's like a 7-month backlog on the silver inventory on paper, meaning that the normal turnaround on like the oil market's like a week. But for silver, they're holding on paper, it's this huge amount. And you can create a derivative to infinity. I mean, you can create, I can just write on a piece of paper, I've got, 27 billion ounces of silver in my account, as long as it's derivative and the bank is willing to back me with paper. And all I have to do is settle in paper. This game goes on for a long time. But I think it's ending. And I think the rush to gold has started. I've said that several months ago, and it will spill over into silver. And we may be at the beginning of that. If I could just go on for another second, and this is a non sequitur, but I want to get it out before I forget. I've said for a long time in my private work that I'm concerned about a cyber attack. And this again goes along with what you just pointed out, Jason. Is this thing real or not, this hack? Well, think about a cyber attack at the appropriate time while we're having this banking situation that can be blamed on. Well, let's blame it on the Russians. So the Russians do a cyber attack, and all of a sudden it's not their fault that they're insolvent. It's not their fault that they made bad loans. It's not their fault that they didn't have the right reserve requirements. It's certainly not their fault that the Fed raised interest rates. It's the Russians' fault. So I just want to get that out there. I am an independent thinker, and I think it's important for your viewers, because anyone that listens to our interview with you gets a little more because you're so good at your knowledge base and the kind of questions you ask.
So it's Putin's fault that Trafigura paid over $500 million for nickel that was supposedly in a London Metals Exchange warehouse and is not there, and the banks are charging them storage fees and insurance costs. Okay, so they're just going to blame Putin. He's like the blanket target there to blame everything on.
You got it.
Yeah, I'm just looking at the headlines on Kiko, some of the ridiculous stuff. The LBMA investigating Perthman allegations over fake gold bars, 100 tons of doped gold shipped to China over 3 years. And then more details coming out about the London Metal Exchange. The CEO urged nickel trading halt minutes after waking up with the court document. And then the stuff that we found out over the summer with the discovery phase, with the precious metal market manipulation. I mean, the banks, the bullion banks that are in charge of, supposedly, if you buy metal and have it delivered, it should be fairly easy, but in reality, it's the exact opposite.
It is. I mean, first of all, most of your industrial users don't buy off the exchange. They might do it in a pinch if they have to, but most of them have direct relationships with refiners and smelters. And a lot of times they get silver in a different form than a commercial bar, because a lot of the fabrication of silver is like wire and powder and mesh and all kinds of different shapes and sizes and purities and all kinds of things. So there's a lot to the silver market that the average silver investor probably really isn't aware of. But the idea that everything has to pass through Go and then get distributed is totally false. Most of what's in the COMEX especially is more for display purposes than anything else. Not saying that they don't deliver, not saying that it isn't available. But remember, the rules of the game are they can settle in cash anytime they want.
They could also delay the delivery of a futures contract for months too, and then they don't get in trouble. So even if the commitment of traders data is totally fraudulent, I think the bullion banks in the past, like JP Morgan and others, they only had to pay a tiny little fine.
Yeah. Well, that gets back to the manipulation thing. I mean, if you look at some of my pretty smart guys in the business, I don't like to berate anyone, but they will tell you that there's never been a manipulation. Well, if you think that through, the way I see it is what they're saying is on a court order or on a settlement case, there's never been the word manipulation in that court document. And that's true. But they use the word spoofing. And was that manipulation? Well, hell yes, it was. But they don't type the word manipulation in the case wrap up. Whatever, I don't know the legal term. So this is semantics. This is gamemanship. It's really just a way to divert some people to look at, let's say, a more of an establishment perspective than mine, because I'm truly independent. I don't owe my life to corporation, a bank, a hedge fund, anyone. And so therefore I can speak my mind pretty freely, whereas others are basically encumbered, even though they will not admit that in many cases.
Yeah, I mean, I've been in gold and silver a long time, David. I learned a lot from you. And I was listening to Jeffrey Christian testify in DC at the silver market manipulation hearings, and he was talking about the amount of paper silver, paper gold, the derivatives, how fractional bullion banking works, and the numbers were just astounding. So, I mean, I guess he's denying what he said under oath, and that was recorded at the time over 10 years ago. But the numbers that he was talking about with the fractional bullion banking were just insane. How much paper derivatives and the futures contract and all the other derivatives on top of the futures contracts are for paper silver and paper gold relative to the actual metal.
Absolutely true. And what is a subset of that, and some people don't know it, is you can determine it to a relative degree by using the commitment of traders report, if you believe they're true. And I tend to think they are. But what you don't hear is what the OTC market, the over-the-counter market is. And they do over-the-counter derivatives at his firm. And I'm not for or against it. I mean, I'm free market. If you want to make a deal with the silver company and hedge their position and write them a contract and charge them for it, that's fine with me. It really is. But the point being that the OTC market is purportedly larger than what the transparent market is. So what he was saying at the time could be bigger in reality than what he stated under oath.
Do you think, though, that there's limits to the paper games that can be played? Because, I mean, if the manipulators if the silver price went to $15 again and stayed there for 6 months or 12 months, wouldn't that bankrupt a lot of the silver miners? Because, I mean, the earnings that we're seeing from the silver miners, and I know you cover a lot of these extensively, David, we're just seeing higher costs still. So even though maybe energy costs are down, a lot of these silver miners, especially First Majestic Silver, and Pan American Silver too, the last 12 to 18 months, they're struggling with their production costs, trying to find that high grade, low cost silver anymore.
Exactly. I mean, I can't add on to it very much. If you look at it over the longer duration, meaning in the last 20 years, for example, you'll see that the actual cost of the price of silver closely correlates to the production cost. But that's not a way to profit. A way to profit is you really want a ratio of 2-to-1, meaning if it costs you all in sustaining cost $20 to get an ounce of silver, you really need a $40 silver price. Why? Because one, you have to make a profit. You have to service your debt. You got to keep the lights on, and you got to expand, because every mine ends in failure. That last ounce comes out that's economic, you close down the mine. So you need capital to be able to find and keep yourself in business. So there's a lot to mining, as you well know, Jason, and it's not an easy business, yet it's the most imperative business there is outside of the energy sector.
Yeah, as you wrote in your books, everything not grown has to be mined. So it's something that most people don't really understand, especially all these ESG people that are saying we need to switch all these internal combustion engine cars to electric vehicles. Well, right now, there's not enough copper supply, not enough silver supply to switch to electric vehicles. So I think these ESG people, the green energy people, they don't understand this basic fact.
They do not. In fact, we did a write-up on that in the Morgan Report a few months ago. And the numbers were just astonishing as far as if you went non-fuel, non-hydrocarbon, completely electric, how much copper, silver, cobalt you would need. And in many cases, you'd have to mine for over like 200 years to get enough to be able to go all electric. On top of that, which really I find somewhat humorous is that a lot of the people in the green movement are against mining, but yet they want to go all electric. Well, you can't have it both ways. If you really want to go all electric, first of all, there's not enough raw material on the planet to do it under current technology. And maybe there's a breakthrough out there. I don't know. But under current technology, you can't do it. And on top of that, you got to mine about 10 times as much as we're already doing. So if you're already upset about this mine and that mine and whatever, because it's destroying the planet or it's an eyesore or whatever the reason, just multiply that by a factor of 10, see how well you like.
And we're scraping the bottom of the barrel for copper deposits. I mean, the grades on silver, David, have collapsed. You've been covering mining stocks for a long time. I mean, we're down bottom of the barrel for silver grades. Are there actually any low-cost silver projects that can mine silver at $10 or $15 an ounce anymore? It seems like the new normal now is going to be at least $20, $25, $30 an ounce silver, or a lot of these silver miners are going to have no profit margins in a couple of years.
Well, you're exactly right. And I'll just say that I do think one of my speculations has the ability to probably get in that $15 zone that you're talking about under, we're setting the clock right now. We're doing a timestamp. We're doing a quarterly statement. We're not doing the long term. But I don't, what happens when they actually go, they get everything, they've got it drilled out, they're going to mine. Okay, well, what does that take? Well, the best jurisdiction of all might take 3 to 5 years. Well, what are labor costs going to be? Are we going to be in an energy crest? Are we going to hit peak oil? I mean, there's so many questions I can't answer. So there are a couple deposits that I'm aware of that are significant, but will they come to fruition or not? In fact, I asked that question of the CEO for my membership. I said, point blank, do you think you'll be able to get through this cycle and be in production? And his answer was probably not.
Also, the rules for a lot of these countries just keeps changing. Pro mining, not pro mining. You have even in a recession or higher interest rate environment, because some of these emerging market countries have had worse inflation because their currencies are even more devalued against the dollar. You have a lot of there's literally protests now in the streets in Peru and Mexico. I think the workers want much higher wages, especially at mines. So we could see, even though Peru and Mexico have very good geology, or Chile has a lot of copper deposits with silver byproduct, we might not see a lot of new mine supply come online because the workers want much higher wages, and then the mining companies either can't afford the higher wages or their cost of capital. They can't go raise the capital to build the mine.
Yeah, there's not much I could add to it. Just an anecdote, I guess, when I was down in Argentina many years ago with David Smith, and it was a very remote location. And I thought, geez, these guys are not getting paid a lot to give up their families for 6 months at a time. I've got a heart, as anyone that knows me knows. And, but I don't rule the world. I don't make the rules. But it's interesting coming home after that and seeing just how soft we have it in the US of A versus some other countries.
Well, do you think that we're going to see mine supply for copper and silver, some of the key base metals, and also silver as a byproduct? Are we going to see supply come offline in Peru and Mexico? Because I know we're starting to see some smaller mines shut down, but there's people out there predicting like substantial supply coming offline for copper and silver in both Peru and Mexico soon.
One, I don't know. Two, I don't want to upset anybody, especially since we have investments in Mexico. But is it possible? Yes, it is. And one of the guys that does some research for me, I haven't connected with in a while, was formulating, I don't think he ever got it off the ground, a consortium of South American countries, including Mexico, to put together what would you call it, a group that would want to keep their silver for solar purposes. In other words, hey, we're in an energy crunch. Solar's the way to go. We have a lot of silver in our country because we need the silver for our own energy needs. We are going to fill in the blank, stop production. All production goes to us. We're going to increase taxes to export it. I mean, it's a variable that's unknown, but it's along the lines of your thinking. And so that would be not necessarily a one-off where they just stop and say, we're not exporting anymore. It would be, well, we've got a reason we're not exporting anymore, but we're going to export, X amount instead of 2X.
I see. So the supply wouldn't come offline. It just wouldn't be exported.
That's what he was implying. Yes.
That's another thing the market's not accounting for right now. So we could see potentially, I mean, we saw that with fertilizer a year ago where a lot of fertilizer was banned, and that caused a lot. We haven't seen food shortages globally, enormous ones yet, but I think that's coming over the next 12, 18, 24 months where these fertilizer export bans and a lot of farmers didn't plant nearly as many crops as they should have. I think that's going to start coming to fruition soon too.
Bingo. Yeah, you hit it. I mean, this is it. Yeah. What I've been saying for a long time, and it's the big picture, if you will, and that is there's no correlation whatsoever, in my view, of the financial markets and the physical economy. I mean, the physical economy has been contracting for quite some time. And yet the financial markets, I know the stock market's off. I mean, I follow this stuff, and the bonds are too, but it's not commensurate with the amount of contraction that's going to take place. I mean, I don't like to say not only are we in a recession, I really think we are going to depression. Now, it'll look different than the 30s, and in some ways, quote unquote, better, in some ways worse, because in the 30s, I think you got a higher moral fiber in the country at large. And you also had a lot of agrarian types that, like, for example, my own parents on my dad's side, they went back to the farm. Well, later in life, I had no idea what the farm was. I kind of pictured, 30, 40, 50 acres. It was an acre and a quarter. But an acre and a quarter was plenty of land to sustain, grandma, grandpa, mom, and dad, and the kids, and a couple cousins. And that's the idea that, people do what they need to do to survive. And I'm not sure what it will look like if I'm correct, and I hope I'm not, that we're going to see further contractions, accelerating food costs, accelerating energy costs. And sure, there'll be a lot of stuff that's deflationary, commercial real estate, some of the stocks in the stock market. I mean, a lot of that. But when it comes down to the basic needs, I think you're going to continue to see price pressure.
So you don't see mining costs, you don't see any type of solution or amazing type of innovation where you think mining costs for silver, gold, copper can come down enormously over the next 5 or 10 years then?
I would say no. I would counter you on that one a little bit. Based on Hecla mining and some of the more advanced, I think maybe 5 years out, all robotics, there is no miners. I mean, they send these machines in there and they do all the work. They don't need a coffee break. They don't need health insurance. They don't whine or cry. You have a couple people that are, service oriented that repair them or whatever, but there will be a huge reduction in the human equation in mining. That I'm almost certain of. Will it be across the board? No. I mean, it'd be first in more advanced areas like the U.S., but that's coming. That I'm almost sure of. We always look at this stuff, Jason, as you well know. I mean, a friend of mine over in the Silver Valley, has a laser situation that he's been testing for quite some time. I'm not convinced it's going to work, but he's still working on it, and it may. So that's what I see it. When you go out that far, I'm glad you gave me a time frame. I would say, yeah, I think we're going to be in a situation where, if the robots are doing it.
That's interesting. I know I've seen some mining executives talk about that. I think Fortescue Metals Group out there in the Perth area, which is pretty barren out in Australia, where there's not a lot of people. I think they have like automated trains. They have some automated trains, but the whole thing's not robotics. But I know some mining executives are talking about robotics. But that seems to me, David, you'd cut your labor costs. Humans would get paid less. There'd be less humans, but then you'd burn through a lot more electricity and energy usage. I mean, your energy bill would go up a lot.
Yeah.
Unless the robots were like nuclear powered on some type of nuclear battery pack or something.
Yeah. Well, in all honesty, I hadn't thought it through that far, but could be. And, some of these places, as you know, Jason, I don't think you've been on as many mining trips as I have.
Oh,
but
no,
I mean, that place in Argentina, it gets so much sun, you probably put up 3 solar panels and run all the robots. I'm being facetious, but people are inventive, and they, especially when the going gets tough, the tough get going. So I'm not saying that would be solved. It's a good point. I hadn't thought of it, but to be determined. Who knows? I mean, I won't even go down to the nuclear idea because I have my very, very interesting take on that whole industry. But anyway, back to you.
Yeah, I think the main point here, though, is the grades are falling. So that means it's going to be really tough for a lot of these. And then especially with higher interest rates and in an environment like this, I mean, the cost of capital for a lot of these miners is way higher unless you're a low cost miner, a large scale gold miner with really high profit margins right now, like Newmont Mining, and you're going out looking to do acquisitions and you're willing to pay more money for Newcrest Mining, which I think Newcrest said we're willing to let you look at the accounting books if you're willing to maybe make a better offer and sign a non-disclosure agreement. But a lot of these smaller miners that don't have enormous free cash flow and profit margins, I mean, their cost of capital right now is nuts.
Yeah, nothing really to add to that, Jason. I mean, as just to reiterate, if you can't grow it, you got to mine it. I mean, the whole system is under such stress from every direction. And as Bob Moriarty said on a recent interview of his, I mean, the black swans are starting to fall. And I agree with that.
Well, if the cost of capital is this high, David, I know you've been in lots of different cycles, bull market, bear market for mining and metals over the years. This type of cost of capital cycle, doesn't it favor the larger and medium-sized royalty companies because they have free cash flow, they have good profit margins, they have access to cheaper capital? So you're going to see them start to take advantage of this and do deals and either fix the balance sheet of miners or lately we've seen mergers and acquisitions for royalty companies. Do you think that trend's going to continue as long as interest rates stay at these levels?
Absolutely. We did a feature article, I think it was in the January issue, so in the last few months, on why you want to be in the royalty space, streaming space. And we've been there pretty much from the inception. I mean, if you look at, some of these proponents that say, you can't buy mining shares because gold outperforms. Well, it depends, specifically. Yes, there are times on the aggregate where gold outperforms gold miners. If you look at like an index versus gold. However, if you bought Franco-Nevada at the top of the market in gold in September 2011, it was about $50. Now it's triple that. So that would mean gold would have to be 6,000 to be equivalent gain in that royalty company. Even silver Wheaton at the top, and it went straight up just like silver during the 2011 buying spree. At the top of the market, when silver was at 50, the price of Wheaton is, I don't have the number, but I know what the chart looks like. At that point, you would have bought at an all-time high. Silver is half that price now, yet Wheaton stock is higher than that high. So this tells you if you pick the right stocks, you can outperform the metal itself. And that's, of course, what we're all about. I mean, I do more than just the miners, do a lot more than just silver. I mean, we've had great luck or success in, copper and cobalt and lithium and the rare earth metals. I was one of the first on that due to a close friend of mine that was really an expert in the field. So he was helping me. I'm not afraid to ask for help. And he had the it's called the inside track in the rare earth element market. So, we look at everything that's resource related, from the small to the big. But again, it's absolutely imperative. And I'm still a believer in peak oil. I still think that we are probably pretty close to it. I'm not a big fan of fracking. I think water is a huge issue that no one really talks about. And I think that the belt tightening for the average citizen worldwide, but particularly in North America, has just started.
And the royalty companies don't have to worry about a lot of workers at the mine demanding higher wages like a regular mining company would. They don't have to worry about higher diesel costs and electricity costs. A big spike like that, all of a sudden the diesel costs doubling. I mean, their profit margins, what if they have a gold stream or a silver stream, it might be 20 or 30% of spot prices, or it's a fixed cost number. So, I mean, their profit margins are fairly well protected, and a lot of these companies are diversified. You brought up Franco-Nevada. People can go and look at a max chart of Franco-Nevada since 2008, 2009. While the paper gold price and silver price were falling, Franco-Nevada was doing more deals, and they were growing top and bottom lines, free cash flow, diversification, growing their dividend too.
Yeah. Yeah, it's one of my favorites. Owned it for years. It's kind of one of the stalwarts of the Morgan Report portfolio.
So do you think then the medium-sized ones are newer? I know Sandstorm Gold's been around about 10 years now, but they didn't have as many cash flow royalties and streams. I mean, they're just starting to get going. Triple Flag just did, I think, a nice acquisition of Mavericks Metals. I heard from some gold company executives that Pan American needed to raise the cash, and then they went and did that acquisition. So do you think the medium-sized royalty companies potentially could turn into Franco-Nevada over the long term?
Oh, that's a tough one. So I'm just going to say my guess. Yeah, I think there's a potential for it. I think it's more unlikely than likely. Why? Because, as you said earlier, the grades have been deteriorating over the last several years. But, you could get lucky. You can maybe get another Midas mine like Franco started with. That's a possibility. It's in fact, I'm quite acquainted with a very, very rich, high-grade miner in Colombia, but I don't know how big it is. I know how high the grade is, but I'm not sure the asset, how big it is. I'm not sure it's drilled. It's not drilled out, so we really don't know.
Oh, so you don't think it sounds like in this environment they might have to sell a royalty or a stream or something to get the financing to build the project, unless they wait it out.
True. I mean, that's the reason, these royalty companies exist, as you well know. And so, do you pay me now or pay me later? And if you make the right deal, it gets you going, and it provides, cash flow and gives you all the things that you get in any business if it's a successful business. And mining, of course, is, again, imperative and a tough one, but it certainly can be lucrative if you're in the right place, right time, and, don't, time it correctly. I mean, the problem with the commodity cycle large is all the mistiming. I mean, people do the opposite of what they should do. When the price is very high, money's easy, you get financing easy, and you start to do projects, and then the price falls, and that economic project that you've already committed to is not going to be very lucrative once you get it finished. And that cycle seems to be like that and has been for some time.
Yeah, and the royalty and streaming companies can invest countercyclically as contrarians. So they have cheaper cost of capital, they have free cash flow, they have access to, they could borrow and use debt or free cash flow, cash on the balance sheet, and they can go and invest that capital towards the bottom of a cycle.
Exactly.
But I think one of the main reasons that the larger royalty and streaming companies, so Franco-Nevada, Wheaton, and Royal Gold, have grown so much, even in the bear market over for a lot of the last 15 years since 2008, 2009, is because of the bank's policy. Because a lot of these large banks, David, a lot of them, it's very difficult to get funding for a mine development. And then the banks are so rigid with the terms on the loan sheet, the debt covenant. So if the mine's not on time and on budget. So I think the royalty and streaming companies have taken advantage of this. Also, a lot of the banks are not willing to go and raise equity capital for the mining companies. So the royalty and streaming companies have helped them out there too.
Totally agree. And I just add one thing, and that is I don't think any of the banks really have a mining analyst. There's some that are good, but like the royalty companies. I mean, the royalty companies have got to put up their capital to get a return on it. whereas the banks are supposed to do that, but I don't think that they do the due diligence that a royalty company or top royalty company does.
Oh, I totally agree. I don't know any banks that have actual geologists on staff going and looking for exploration upside. I mean, most of the mining analysts at banks are numbers crunchers. They're looking at the financial statements.
That's all they look at. Yeah.
So the royalty companies will have geologists on staff. They will send consultants out to the field to go and look at projects. They will have geologists not only going on site visits, looking at maps, looking for potential there. Sandstorm Gold even has mining engineers on staff, and metallurgists.
Yep.
So they're doing a lot more due diligence than a bank would for the bank giving out loans. But I mean, the bank's not flexible at all on their loan terms. So if you violate a lot of the loan terms for the bank, I mean, you're pretty screwed.
Exactly. Well, that's why, the market's pretty efficient if it's free. And that means if there's a need, it can be filled. And of course, Franco was one of the first to do it. As you know, Royal Gold has done a great job. Wheaton Precious Metals, Wheaton Silver at one time. So, that's the story, really. And you hit it on the head again. I mean, this is why we are where we are. And this is why, I've survived, let's say, the major downturn in the precious metals or the commodity sector. And yet, some of our picks kept going. I mean, at Kirkland Lake, which kind of saved us as that company went up as a 10-bagger while everything else was going the other direction. But it's not been easy. It's been fun. And I'm very passionate about it still, but I really think, unfortunately, with this banking crisis, we may be getting a lot more eyeballs into our work because it's more than just the miners. It's strategies and it's buying physical. And I can help anyone get a much better price than the internet marketers if and only if they're in a larger category, which means what, David? It means 50,000 or up. But there are people out there with that. In fact, Jason, if I might just rant for a moment, during this last upset, not this one we're in, but one that was a bit of a gut wrencher, I had 3 or 4 calls that were basically, David, I listened to you for 3 years and I trust you, but I've got $2 million in the bank. I've never bought gold. I don't want to make a mistake. What do I do? I had like 3 or 4 like that. I mean, back to back to back, not within 4 days, but within about a couple of weeks. I think I'm getting a lot more of those calls as this thing unravels further.
Well, I mean, governments are even asking those same questions. So you have Singapore. Singapore could go get, 5% on U.S. Treasuries if they wanted to recycle their trade surpluses and foreign exchange reserves into buying U.S. Treasuries. They can get 5% from U.S. Treasuries. Instead, what they're doing is buying 44 tons of metric gold. And then the People's Bank of China has increased their gold holdings the last 4 months in a row.
The run to gold has begun. I said it, 4 or 5 months ago. It wasn't easily seen. It was kind of in the stealth mode. And then when that news release came out about the amount of gold that was added to by central banks, being, I think, the largest in 11 years or something like that, that sort of
50 years, 1967, since the London Gold Pool ended, I think, David.
Okay, fair enough.
But I think this is these governments acknowledging that they don't trust the U.S. government finances, because logically they should be saying, well, I can earn these return rates, even though the CPI is higher than the interest payment that the government is paying, I would still earn those interest payments. Instead, they're buying gold. So they're saying we don't trust U.S. government finances and the strength of the dollar. The U.S. government's mismanaging it with their spending.
Yeah.
Well, as we wrap up, David, I want to get your thoughts on some of these acquisitions that we've had lately with Agnico Eagle and Pan American Silver buying Yamana, B2 Gold buying Sabina, Hecla buying Alexco, and then these bids for Newmont Mining has in for Newcrest. So are we going to see more of that where the companies that actually have low costs and good profit margins, are they going to keep being more aggressive for acquisitions?
Yes, I believe so. As you said, or we talked about, I guess I voiced it, that, every mine ends in failure. So if you're going to stay in that business, you need to resupply. And how do you do that? Well, if you're a conservative, large company like the ones you named, you don't want to make any mistakes. You want to know the assets there. You want to know what the grade is. You want to know how long you can mine it. And most of those factors are taken into account on these type of mergers and acquisitions. And yes, they will continue.
And those are the larger and medium-sized companies. So these are the ones that actually have good cash flow and profit margin still. So if you're a smaller junior and you're trying to build a mine, it's a totally different story than the larger and medium-sized ones that have good profit margins and free cash flow right now.
So different. cannot be overemphasized.
Well, yeah, if you're a junior right now, I mean, with where interest rates are just on US Treasuries, I mean, mining company access to capital for debt and equity, I mean, you're looking at above junk bond rates. Rick Roll has talked about this in the past. So now what royalties and streams are a normal part of the capital structure. I know 10, 12 years ago they weren't. They were considered like really exotic. But now a lot of these smaller juniors that are looking to build a mine, I mean, they're seriously considering putting a gold stream on it immediately if it gets them 80 million, 100 million, 150, rather than paying ridiculously high interest rates.
Yeah. Well, now we're about to wrap up. I'm going to throw you a curveball, Jason, and I really don't. We can discuss it briefly, but I'm just looking at my Twitter feed, and my friend Michael Maloney from goldsilver.com just put up a survey, and he just published the final results. If you were going to run, in other words, run a bank, with the bank run, what would you run to? He's got three things. Would you run to gold, run to bonds, or run to Bitcoin? Pretty interesting. The run to gold or silver was 47%. The run to bonds about 3%. So hardly any. And the run to Bitcoin was over 50%. And I'm not a big Bitcoin fan. Anyone that's watched the Crypto Conspiracy series of 29 episodes by yours truly and others, you'll know the reason why I'm not that big a fan of Bitcoin. But what I find interesting is this survey that more people would run to Bitcoin for safe haven than would run to gold or silver.
It depends on their age. It depends on their age, David. A lot of younger adults are pretty anti-gold and silver. So if they're a millennial and they've been working in tech and they've had access to the internet for a long time, a lot of those people are really anti-gold and silver.
Yeah.
But I think it's smart personally to have some diversification. I mean, a lot of these people that are into Bitcoin and crypto, their idea of diversification is owning Bitcoin and other altcoins and NFTs.
I know. Yeah.
I mean, personally, the valuations, David, on some of these royalty company shares, so Sandstorm Gold, some of the small and medium-sized ones, I mean, Sandstorm Gold's over 25% discount in net asset value. Some of these ones are just insanely cheap right now that you can buy and hold and wait 5 years out from now, and they're just going to grow.
Yeah, you're absolutely right. And we're hanging in there. We've lost some of our subscriber base, and, I try to take it all in stride. But, a lot of people are very patient, and yet you need some more. And it's like, I'm tired. But a lot of our people just hang in there as they should, because I think the next leg up, once it gets going, is going to be one for the record books. I know I've said that before, but I truly believe it because, with Mike's survey here, half the people would run to gold and silver. Well, what happens if Bitcoin goes down to 10,000? How many of those non-believers will be moving out of Bitcoin into the precious metals? I'm still a very large bull, and the only reason I think that the paper price of gold and silver are going to get so high is the converse of the banking system. I mean, this is where I have a huge different way of thinking than, say, Jeff Christian. I mean, Jeff's good on most numbers, but his belief system and mine are totally different. I'm looking for a fiat failure, and he thinks the banking system is going to go on forever. And I don't think he's right, but he's looked good in the past because certainly, some of my calls have been premature. But I think the day of reckoning is upon us.
I also think there's a big disconnect between the share price and the profits. So the earnings, the profits, the profit margins, free cash flow for some of these gold stocks, the low-cost gold miners, and also the royalty companies. I mean, Osisko Gold Royalty just had an outstanding quarter, just crushed it. They have a lot of growth that's coming online. Sandstorm Gold's the same way. And these stocks are just hated and cheap. I mean, Sandstorm Gold, like the negative bias is just nuts if you look at it. But if you look objectively at the company's profit margins, free cash flow, all the growth that's paid for, I mean, they have a lot of good future growth that's already paid for the next 3, 4, 5, 6 years. And if you just looked at the stock price, you wouldn't know it at all. So I think there's a lot of these types of gold stocks, especially the medium-sized and smaller gold royalty companies, where an investor, a contrarian, they didn't buy all their position at once. There could be a really bright future there. I mean, if the gold prices, David, are going to stay above 1,800, these royalty companies are just going to mint money because they don't have to worry about it. Higher labor costs, higher energy costs. They have free cash flow. They're just going to mint money while people complain about the share prices.
Exactly. That's right.
Well, I'm just looking at these earning calls. I mean, Osisko Gold Royalty, they crushed earnings. Sandstorm had a very good one, paying down debt, especially at these earnings prices. That Sandstorm has a really large gold stream coming online in the next under 12 months. It's one of the largest ones in Canada. So the market's just not pricing any of these things in.
Couldn't say it better myself. They're still here. We're still in business. It's time to climb on board. It's unfortunate that people don't buy when they should.
Well, I've kept
once we get above $30 silver, there will be a lot of buyers, but they're not going to want to buy it under 25.
I was actually trying to buy more shares of Sandstorm Gold around $4.70, and then we had the big move up today where the gold price popped, and now the shares are back above $5. So I guess I got to wait with my cash to go buy more.
Yeah, it's going to be interesting how this thing continues to unravel. And I think that once these gold shares catch a bid and start, like IBD, Investors Business Daily, and it shows what sectors are in the lead and the miners become in the lead. And that's going to trigger off a lot of algorithms. And all they do is look at what the math says or who's the leading industry. And then they start to, move down from there and they start to do their analytics. And there's a lot of money, or I should say currency. There's a lot of currency seeking value, seeking capital gains, and seeking safety. And you have that in the mining sector, particularly in the precious metal sector.
Well, I don't think some of these royalty companies will exist that much longer, because if the valuations are going to be that cheap, you're going to see Osisko Gold Royalty, Sandstorm Gold taken off the board by the larger senior players looking to add growth, especially if the valuations are that discount. I mean, we've already seen absolutely enormous mergers and acquisitions in the space. Mavericks Metals was taken out by Triple Flag, and there's been a lot of other. Sandstorm bought Nomad, and Royal Gold bought Great Bear Royalty, which doesn't even have an actual feasibility study on the mine yet, but that potentially could be one of the largest new gold mines in Canada 7 to 10 years from now. I think we're going to see even more royalty mergers and acquisitions if the valuations are this cheap.
I think you're right.
Well, David, I really enjoyed our discussion today. If my listeners want to take a look at the Morgan Report, how did they do so?
Let's go to the main site, themorganreport.com, and lots of free information. In fact, everything is free except for the paywall, which on the front page, it says members only in yellow. You got to click that. If you're not a member, you're not going to get access. But I do a lot and have and will continue to do so, because one of my primary purposes is to educate my fellows on what's going on. And you're doing the same thing, Jason. And I tip my hat to you. You've been not only a friend, but you've been, as I said earlier, this is one of the interviews. I love doing them all, but there's some that are more, let's say, knowledgeable than others as far as, what they know, especially about the mining sector. And you do. So thank you for the opportunity to speak with you.
Well, actually, I learned a lot of it from you and Steve St. Angelo, reading articles over the years, also interviewing a lot of CEOs. So I was reading the conference calls, but I learned a lot from speaking back and forth in emails and on the phone with you over the years while you were mentoring me. So I always tell people who ask me, how did you learn so much about mining stocks? Well, I was mentored by David Morgan, who's been doing it longer than pretty much anyone else.
Yes, that's true. I have to laugh.
Well, yeah. I mean, you bought Silver Standard, below $1 and sold it at 40. So that was one of the best speculations of your entire career.
Absolutely. And I don't know if I can drop names. I won't. A large money manager was caught the silver story pretty early because he connected with me pretty early. And they were doing a financing, and he was going to do it all. He's going to take it all. No, I'm not going to do it. I'm going to do it all. No, I'm not going to do it. Maybe I'll do this much. He ended up doing a pretty good size position, did not take the whole financing. And it closed out. I'm going to give the general idea. I don't remember the exact numbers, but it closed out at like 180 or something. The warrants were at like 220. By the time the deal closed, the stock was up to like 250. I mean, he doubled. The stock price doubled within about 6 months. he was very happy with.
Sounds like Silvercrest. My friend Dave Kranzler, he was in below $1 for Silvercrest metals too when they spun it out from regular Silvercrest after First Majestic bought them, and then he sold a lot of the shares at like 6 or 7. He sold out after buying below $1, so I think he got like enormous returns.
Yeah, can happen, and it doesn't have to be in some junior either. It can be in a mid tier or the junior thing. I want to close out, but we can talk about juniors next time.